This is big. You should write this down. Research, research, research. Okay, on all your sheets of paper, because that's where you find your trades. You don't find your trades by looking at numbers. You find your trades by researching. I'll give you some examples. Commodities display a seasonal behaviour, and their behaviour is influenced by the production cycle. Would it surprise you to know that in most grain markets that they plant once a year and harvest once a year? Right? How many people does that become a surprise to? Well, about 8 years ago it became as a big surprise to me. Right? Big surprise. They plant once a year and they harvest once a year. I'll tell you something about the planting and harvest cycle. The planting time is usually the high of the year and the harvest time is usually the low of the year. Who knew that? A couple of you? No? A couple over here. In most grains, the planting time of the year is usually the high price of the year and the harvest time is the low time of the year. So we know when the low is and we know when the high price is, don't we? So therefore we know when we should be selling and we know when we should be buying, don't we? And why don't we do it? October is the Northern Hemisphere harvest low in soybeans, and May, June is the Northern Hemisphere plant in soybeans. Let me give you another example. It's cotton. May, June. Guess what occurs around about this time? Planting, absolutely correct. Guess what occurs around about this time? Harvest. It's not rocket science. There's a very good reason why. Has anybody worked out why? Okay, someone's got it. The planting time is the one time of the year where you have the least supply, don't you? And the harvest time is the one time of year where you have the most supply, don't you? Okay. Systems employed by consistently profitable traders, and I add the word consistently, and funds are trend following. They need trends. Now trends are simply we can call them a price distribution. We can call them a move from a low price to a high price or a high price to a low price. You know, from planting, you look for a trend down to harvest lows. From harvest lows, you look for a trend up to planting highs. There's 2 trades a year. Be a buyer when you should be a buyer. Now in grains, you know the secret now. You know when to be a buyer in grains. And you know when to be a seller in grains. And to a lot of you, that comes as a bit of a surprise. But don't be a buyer in a falling market, and don't be a seller in a rising market. You know, there's a couple of sayings in the market. You know, if you're long in a falling market, you don't like money. Right? If you're short in a rising market, you don't like money. Let's talk about heating oil. Heating oil has demand around about January is very, very low. Why is that? Okay, July is their summer, the middle of their summer. Heating oil, no one wants heating oil because it's not cold. They use heating oil also to run their air conditioners as well. The petroleum industry anticipates increased demand for heating oil in the oncoming winter at around about June, July, August. And they start buying heating oil. Therefore they start buying heating oil futures contracts to lock in prices, to hedge out price rises. So the price of heating oil rises regularly every year, a couple of times, but in the latter part of the year there's a very, very regular and reliable bull market in heating oil. For 15 out of the last 15 years, that heating oil rally has been profitable. Knowing that there's a 15 out of 15 year success rate in heating oil, who doesn't want to know a little bit more about trading it? I'll show you the pattern. Here's the pattern. May, June, April. From this period of time on, we're looking to acquire heating oil contracts for our portfolio. There's a very, very reliable trade between August and October. in heating oil at the last end. Over the last 5 years, we've made $8,000 in a heating oil contract, nearly 1,800, 7,000, 2,000, and nearly 12,000 in heating oil each year. And these are these rallies. First rally, second rally, third rally, fourth rally, fifth rally. And what do you notice about those rallies? The one thing we can do is say there's a supply and demand imbalance, and therefore we know that these prices have got some pressure on them to rally. What I can't tell you is how far they're going to go. See, I'm not in the business of forecasting. Okay? You can only take what the market gives you. Does that make sense? I have a question. Heating oil is the same as crude, about $4,000 US per contract. Okay. Australian Share Price Index. If you'd bought it at around about 28 when the bull market started, and you were still holding it a little later, you'd have $6,000 profit. Who's happy? Yeah? Not happy. 16 grand doesn't mean much. Okay. That was from there. Let's say you bought it back here, from 28. You'd have $33,000 worth. Who's happy? Everyone. Okay, a little bit more. Happy with 33 over 2 years. What if we bought it every time the market made a new high? Okay, let's keep it simple. Okay, in a rising market, what should the market do? Make new highs, shouldn't it? Does that make sense to everybody? That's about the extent of our technical analysis lesson today, right? I'll show you